Welcome to this week's market presentation. Latest news. Starting with the latest developments, progress in ending the war in Gaza appears to have been made over the past week as Hamas agreed in principle to President Trump's 20-point peace plan. At the center of the peace proposal, Hamas would agree to a full hostage release, the disarmament of Hamas, and to transfer the control over Gaza to an international technocratic body. In exchange, Israel would be prepared to partake in a prisoner swap with Hamas, as well as agree to a withdrawal from the Gaza Strip. Hamas continues to seek international guarantees that Israel will not resume hostilities once hostages are released. Nonetheless, this is one of the first instances of real progress in ending the conflict in some time. If progress continues to be made, oil and gas markets are likely to begin easing some of the current risk premium that is being priced into oil and gas futures. Over in France, the French political crisis deepens as French Prime Minister Sébastien Lecornu resigned this past week. With no budget in place and no budget that has been agreed upon in Parliament, uncertainty grows regarding the state of the French economy in particular. French bonds and stocks dropped significantly over the past week following the news, and there is now the prospect of both Moody's and S&P's downgrading France's credit rating, which would lead to higher borrowing cost for the nation. Over in the US, the government shutdown that began last Tuesday at midnight continues. In terms of the impact on markets, financially, bets on Federal Reserve interest rate cuts were boosted due to the ongoing shutdown, as well as due to the weak jobs report that showed negative growth in the labor market over the past month. The US dollar fell, which for US price commodities was a bullish signal. And while it is hard to assess the impact that the shutdown will have on the US economy, most expect it to be a negative one. More importantly, however, is that the shutdown of key federal agencies that typically and routinely release and report on key economic indicators will no longer be doing so, adding uncertainty and a lack of visibility on the state of the US economy. Lastly, over in Japan, Japan's political shift and economic outlook has taken a turn following the Liberal Democratic Party leadership victory by Sanae Takaishi, positioning her to become Japan's next prime minister. On the economy side of things, she's an advocate of aggressive fiscal stimulus and a loose monetary policy. On terms of energy, she's a strong supporter of a nuclear-focused energy policy, pushing for a greater self-reliance on the energy sector. If she is able to push Japan into increasing the share of nuclear energy out of the energy mix, we could see a corresponding reduction in the dependency on natural gas, easing the demand on LNG imports into the country, resulting potentially in a looser global market for LNG. Weather. Moving on to the weather forecast, above average temperatures are forecasted over the next 7 to 10 days across Western and Northern Europe, with parts of Central and Eastern Europe continuing to see below average and colder temperatures. Precipitation is expected to be limited over the next 7 to 10 days, although at the beginning of the week, we are still expected to see better levels of precipitation in the Nordic region. Lastly, over in terms of average wind speeds, there we see an improvement over the past week, with higher wind speeds expected, particularly through the middle and end of this week. Lastly, looking at the hurricane season, here we note a greater than 60% chance of a hurricane forming in the Atlantic. Still, no clarity on what direction it will take and whether it will end up impacting U.S. oil and gas production or, very importantly, U.S. LNG export activity. Microeconomics. On to Macroeconomics. Global PMI figures for the month of September showed a contraction month over month, with PMIs decreasing by 0.5 points in September. In terms of the composite PMIs across key economies in the world, we see a deterioration in the US economy, dropping by 0.7 points, while the Euro area composite PMI remains stable, still in growth territory. Taking a closer look at the PMIs, we note a deterioration of manufacturing PMIs across the board, except for China, likely due to the ongoing impacts of the tariffs and trade uncertainty imposed on by the United States. Over in the service sector, we see that across most countries, this is one of the brighter spots and one of the reasons why we continue to see economic growth, even with a worse manufacturing outlook. Crude oil and LPG. In terms of crude oil prices here, we note the decrease in crude oil prices over the past week, with the front month decreasing by roughly 7% for both WTI and Brent crude oil prices. The decrease in the market appears to have been driven by the announcement by OPEC Plus that it would increase production quotas by a further nearly 140,000 barrels per day in November, continuing what has been a very persistent and significant increase in production quotas over the past year. At the same time, as the supply outlook continues to brighten due to that, demand expectations continue to be weighed down by the weaker performance of the US economy based on the economic indicators released over the last couple of months, and the prospect of slower global economic growth in the coming year weighing on crude oil consumption. The latest forecast by the EIA shows a further increase in their supply outlook for the coming year, while on the demand side, we've seen much more modest increases, pushing what was already an oversupplied forecast further into positive territory. Natural gas. Natural gas prices saw a decrease over the past week, particularly looking at the 2026 products, with the calendar year decreasing by 4%. The decreases became more modest as we look further along the curve. Gas storage levels remained around 82% full, and in terms of the injection rate, we saw a deterioration there, with injection rate falling below the past 12-year average, moving closer in line with last year's injection rate for this time of year. That has meant that the storage deficit versus the previous year has remained steadily around the 12% percentage points, resulting in that ongoing significant deficit. In terms of storage levels across European countries here, we note the fact that Germany's storage levels remain below the European average. And as we look forward to the coming weeks, we would expect for most injections now to be coming into Germany, with other countries, particularly looking at Italy and France, are well above the European average. One other interesting point is that this past week saw the first daily net withdrawals since the end of this past winter. It is yet to be seen how this will end up impacting overall storage levels and whether weather conditions will remain favorable towards higher storage levels moving forward. In terms of total supply and demand, here we note an uptick in both total demand and supply. Total demand, which was coming from the lowest levels in over 5 years, now moving closer in line to the past 5-year average, while total supply, seeing an increase week over week, remains near the bottom of the range over the past 5 years. The European gas supply mix biggest movements this year versus last year have primarily been an increase in LNG imports and a further decrease in Russian pipeline imports. Looking at the supply mix over the past week, we note that the maintenance season in Norway has wrapped up nicely with no extended outages, resulting in lower flows than anticipated, and now we're seeing those flows once again above the 300 million cubic meter per day level. Over in LNG sendouts, we've also seen those increase week over week, with LNG imports in Europe increasing as well. Price competition for LNG with Asia remains weaker than at other times in the year. A big driver of that is one, the fact that China is now sourcing LNG from Russia's sanctioned Arctic LNG terminal, and the fact that LNG storage levels in China in particular remain at quite high levels, reducing demand expectations from the country during this upcoming winter. Lastly, investment fund positions for TTF remain relatively stable over the past few weeks, owing to the stability in prices that we've seen as well. Coal. Coal prices saw a slight decrease over the past week, and for European coal prices, we've seen a continuation of the bearish price evolution we've seen over the last few weeks. Overall, the limited power sector demand in Europe, as well as the current limited heating demand, has meant that overall coal consumption has remained relatively muted. And as a result, the current levels of coal stocks at area terminals remains more than ample. Moving forward, depending on weather conditions, we could see some additional support for coal consumption in Europe. Lastly, one other factor limiting coal demand in Europe are the increasing carbon prices across Europe, increasing the cost of coal-fired power generation, and as a result, increasing some coal to gas switching. EU and UK emission allowances. As I just mentioned, carbon allowance prices in Europe continue to be moving upwards. Over the past week, we've seen a 4.2% increase on the European side of things and a 5% increase on the UK side of things. On the UK side of things, we continue to see the market find support due to the ongoing discussions and progress on linking the EU and UK carbon markets. On the European side of things, the cover ratio at the latest auction showed continued strong demand in the market for allowances, adding to the bullish sentiment. At the same time, the uptick in gas consumption over the past week has led to an increase in emissions from the power sector, which added some support to carbon emission demand. Here we see the uptick in emissions from the power sector moving from the lowest level seen over 5 years, now closer in line with the 5-year average and in line with the level seen in 2023. Electricity. Electricity prices in Germany have seen a relatively stable price evolution for the front year, remaining stable week over week. However, further along the curve, starting with 2027 and beyond, we're seeing a more bullish price evolution, with markets starting to eat into the backwardation that we have had throughout most of this year. Electricity prices across other European markets have seen a similar price evolution with relatively stable movement over the past week. One exception would be France, which had seen a more clear bearish price evolution over the past few weeks, in part owing to the improved nuclear power output, although we did see a slight uptick over the past week. In terms of total demand and residual load, we see total grid demand near the bottom of the range over the past 5 years, while residual load, seeing a little more movement week over week, has now similarly settled to the similar levels as last year. The European supply mix, as we can see here, has now turned a little less favorable towards renewables, particularly as solar power generation continues a structural decrease as we move into the fall. While at the same time, we can highlight the poor performance of hydropower output, which has in turn increased the demand and the share of both gas and coal power generation over the last couple of weeks in particular. One bright spot is the improved weather forecast for wind speeds across Europe, which is expected to boost overall wind power output. In terms of nuclear power generation, here we see a decrease and output over the past week, but nonetheless, French output remains at the highest levels over the past 5 years. Renewable generation has moved below the levels we saw last year, owing in part to the poor hydro and the decrease in solar, although we see an uptick over the last few days, owing to an uptick in wind. At the same time, we see the opposite trend for fossil power generation, with an uptick as renewable output was decreasing, and a decrease now that there's an uptick in renewables. Renewable power generation have seen that boost due to wind, given the decreases in both hydro and solar, although it must be noted that solar remains at a record high for this time of year. In terms of fossil gas generation, we see how fossil gas power generation has increased to just near the past 5-year average, significantly above where we were just a couple of weeks ago. At the same time, coal power generation has seen a modest increase, although slightly lower than gas, in part due to the level of carbon prices, but also the lower overall power generation capacity. Lastly, looking at hydro reservoir levels, we note that other than in the Iberian Peninsula and in Switzerland, most European countries are seeing a worse hydro storage levels compared to earlier in the year, weighing on the hydropower outlook in this remainder of 2025. Lastly, looking at the guarantees of origin, we note a bearish price evolution across production technologies and across production years, as the outlook, particularly for renewables, namely wind and solar, brightened, as well as the lower demand that we're seeing over the last couple of weeks, as opposed to earlier in the summer, where we saw increasing buying demand from market participants. That covers this week's market presentation. Thank you for joining.